Most banks are building artificial intelligence they should have bought. It is the most expensive instinct in the industry, and it hides behind a flattering story. We are a technology company now. Our engineers can build anything, and the cost of writing code is falling. All three are partly true. None of them justify what the build bias actually costs. Here are the numbers the board rarely sees. In financial services, between 82 and 85% of in-house artificial intelligence builds fail, against 25 to 50% for ordinary enterprise technology projects. When banks try to scale those builds across the enterprise, by some estimates, as many as 95% of pilots never reach production at all. Billions of dollars sit stranded in proof of concept, returning nothing on the profit and loss statement. Most banks fail here not because the algorithm is wrong, but because the data and the infrastructure underneath it cannot carry the model in production. A fraud model with perfect accuracy in a sandbox is useless if it cannot reach real-time transaction data behind a legacy core. As one analyst put it, these are not artificial intelligence failures. They are infrastructure failures wearing an artificial intelligence label. Compare the economics directly. A custom build runs $500,000 to $2 million upfront and 12 to 24 months before it returns anything. A commercial platform runs $50,000 to $200,000 and delivers value in 3 to 6 months. Across 3 years, buying costs around 56% less than building. So the question for this boardroom is not whether your engineers can build it. The question is whether building it earns its place. When the instinct is to build, leaders should ask one thing first. Do we own a moat here? Or are we about to rebuild something we could have bought this quarter? To answer that, you need a map. Every artificial intelligence capability in a bank can be placed on 2 axes, and where it lands tells you how to source it. The first axis is strategic differentiation. Does this capability create a defensible advantage, or is it a commodity your competitors can buy off the same shelf? If they can, it is not an edge. It is table stakes, and building it yourself wastes scarce engineering talent. The second axis is internal readiness. Do you have the proprietary data, the talent, and the architecture to build this and, the word that matters, sustain it? A capability can be genuinely differentiating and still be the wrong build, because if you lack the real-time pipelines to feed it, the project will be abandoned no matter how good the idea was. Cross the 2 axes and you get 4 quadrants, 4 verdicts. Build. High differentiation, high readiness. A real moat you can sustain on proprietary data and elite talent. This is the only quadrant that justifies an in-house build. Partner. High differentiation, low readiness. The edge is real, but you cannot sustain it alone, so you co-develop with a specialist and keep the proprietary workflow. Buy low differentiation, a commodity function. Purchase it, take the fast time to value, and carry none of the maintenance. Assemble. You have the readiness, but the model itself is no edge, so you fine-tune or retrieve on a bought foundation model instead of training from scratch. And that last verdict settles the question every Chief Information Officer is asked. Should we build our own model? Training a frontier model from scratch costs upward of $78 to $100 million. Fine-tuning an existing one costs $500 to $5,000, a saving of 60 to 90%. For a bank, building your own model is almost never the answer. Assemble, do not build. So where does building actually earn its keep? Only where you own something no vendor can sell. Your own data, your own workflow. Real-time fraud detection on your own transaction ledger qualifies. The proprietary graph and the millisecond latency are things a general vendor cannot match. Credit underwriting on your own performance data qualifies. Systematic trading logic qualifies because the logic is the advantage. But a chatbot, a document extractor, a coding assistant, those are commodities. Building them in-house spends quant talent on work a vendor already does better and cheaper. Now the part the grid alone will not tell you. In a regulated bank, three forces override the theory. First, liability stays home. Buying a model does not move the regulatory responsibility 1 inch. You remain accountable for its fairness and its outputs, so any purchase must come with audit logs and explainability good enough for your own governance. Second, speed against opportunity cost. A model you can deploy in 3 months often beats one you build in 24, because the cost of waiting 2 years usually exceeds the price of the contract. Third, lock-in. Lean entirely on one provider and you inherit its price increases and its outages, what the field now calls token inflation. The disciplined banks architect for model agnosticism, so they can swap one provider for another as the economics shift. When you buy a tool, leaders should remember the harder truth from this series. Buying is the easy part. The value is not in the tool. It is in redesigning the operating model around it. The purchase order is not the strategy. Look at who is getting this right, and the pattern is clear. Capital One builds its own fraud detection, graph models on its internal ledger, because that is a genuine moat. Bank of America built its knowledge assistant in-house on more than 3,000 of its own vetted documents. Those are billed decisions, earned by proprietary data. But when the edge is real and the talent is not, the same bank's partner. HSBC partnered with a specialist for anti-money laundering network analysis. Morgan Stanley partnered for wealth advice and wrapped the model in its own guardrails. And Singapore's DBS generated close to $1 billion Singapore dollars in value, not by building foundation models, but by orchestrating more than 1,500 of them. Assemble and orchestrate. Do not train from scratch. The regulation now rewards this discipline. Revised United States model risk guidance scales oversight by materiality and pushes generative and agentic systems onto the bank to govern. Europe's deployer rules mean buying a high-risk credit model still obliges human oversight, an impact assessment, and a right to explanation. Vietnam's data decree requires vendor data transfers to be assessed before they happen. Outsourcing the model never outsources the liability. There is a systemic edge too. As more banks buy the same few models on the same clouds, the system converges and can move in lockstep under stress. Concentration is no longer just your risk, it is everyone's. So here is the loop to run on Monday. 4 steps. Score each capability for differentiation, moat or commodity. Score it for readiness. Can you sustain it, not just pilot it? Root it. Build, partner, buy, or assemble. And for any build, demand the data moat in writing. Govern the vendor, deployer controls, a concentration limit, and a model-agnostic exit before you sign. Stop building what you can buy. Build only what you alone can own. I am the AI business architect. Design the future. Defend the enterprise. Subscribe now.